Hey kids, Uncle Doug here dropping knowledge on you. Mortgage knowledge that is from the Conejo Valley, Westlake Village, Thousand Oaks, Agora Hills, that area over the weekend. Look, there's an awful lot of people that are worried about their jobs right now. 40% of Americans are concerned about their jobs. That's a big number. We also have two other interesting things going on. We have more equity than we've ever had in houses in the history of the United States, and we have more consumer debt. So how do I tie all this together? Well, if you've got equity, you can't eat equity. You need a vehicle that allows you to spend equity. That can be a mortgage or a home equity line of credit. If you have a mortgage, especially people who have low interest, COVID rate type rates, in the 2s, 3s, 4s, and you're concerned about giving up the rate, first of all, you can't eat rate either. So cash flow is what you should be concerned about. But the point is taken. If you don't want to get rid of your 2 or 3% mortgage, and if it makes sense when we look at what's called the blended rate, which is when we look at the rate of your first and second combined to see what the real number is, we offer HELOCs up to $500,000. So you can get a second line of credit against your house. You have your first mortgage, then we put a second behind it. We can go up to $500,000 that you can borrow out. And here's the interesting thing. This is what the wealthy do. You can live off that money and it is not taxable. Borrowed money is not taxable. So if you've got a truckload of equity in your home, there is an argument to be made that, and again, this is, not one scenario fits everybody. So I'm going to stipulate that right now. But if it makes sense, A, for you to maybe pay off your consumer debt, that might be at 20 and 30% interest with a much lower percent interest, longer stretched out payment of a HELOC or line of credit or a mortgage, and give yourself a break on your cash flow. Secondly, if you're concerned about your job, once things go sideways, if your job is in jeopardy and you get laid off, it is already too late. If you don't qualify, most mortgages are income driven. You have to qualify with income. If you lose your income, you're in trouble. If you have a HELOC or a line of credit before you get laid off, you're still liquid for whatever that line of credit is. It's a safety net. That's how you avoid something bad becoming a complete catastrophe. Reach out to me. I'd like to help. I have first position and second position HELOCs. I have one loan in particular called the Home Select. That is an absolute game changer. We have clients that, if used properly and if they qualify, this is for people that have more money than month. This particular loan is producing comparison loan effective APRs in the 1s, 2s, and 3s for qualified borrowers. Each scenario is different. Again, I'm not telling you that's what you're going to get. We have to run your scenario. You can learn a lot more at gohomeselect.com. Have yourself a fantastic Friday. Reach out if you have any questions. I'm here to help. 805-231-1644. I'm currently licensed in California, Nevada, Texas, Colorado, and Florida. I can get licensed just about anywhere within 24 hours, 48 hours at the max. I'm here to help. Reach out. Uncle Doug, dropping knowledge. Have a great day and have a great weekend. Happy Thanksgiving, everybody.